are back, Newport Beach, California, and PIMCO, and arguably the most important conversation of our hour. Mark Kiesel joins us. For years in equity derivatives and following corporate bonds now, it's the one place to hide. Is that true what I just said? Sovereigns, you can't. The Fed's taking care of that. Equity dividends, the Neil Kashkari space is so in. Is there opportunity in corporate bonds?
Well, we think there is select opportunity. And the reason is because if you look at the developed markets, you're basically looking at negative real returns out to 10 years. And what you can get in corporate bonds is roughly 5, 6, even 7% yield, which looks very attractive to equities with roughly a third the volatility. So investors on both sides, equity investors and cash investors, are moving into corporate bonds.
Can you buy high quality corporate bonds yielding much lower than that, or has that just been priced up, yield down?
Most of our investments right now, for example, the funds I run in investment grade are yielding a little bit above 5%, and they're basically focused.
That's a big return.
It's not bad relative to cash or relative to equities, and our investments are very much focused on companies which have stable to improving fundamentals and are really tied into emerging market growth.
Well, you think of Neil Fuss at Loomis Sales and the idea of taking that coupon and making a total return. I would suggest you've got a nice yield coming in, but total return is really at risk. Do you just presume no total return and you only make the yield, or could you even see a 3% return instead of a 5% return?
Well, you could see a 3% return, for example, if yields were to back up significantly. We're not expecting that. One important point which you highlight is that you want to buy companies in a credit story that can independently delink from rates. So what you really want is a credit where there's spread tightening potential. And there are a couple areas where we're focused now, for example, U.S. banks, pipeline companies, and energy companies, where we actually see tightening potential.
You're in the banks. What kind of flavor of banks are you in? Are you buying J.P. Morgan bonds? Is there such a thing?
Yeah, we're basically avoiding Europe, and we're focused primarily on U.S. and emerging market banks, staying senior in the capital structure because we do recognize the fact that we're in this deleveraging trend, although the valuations are very attractive and the fundamentals are improving.
There's a restaurant, I don't know what it is, a takeout place 5 stores down from Neiman Marcus, right around the corner from here. You and I sit down at a table with a random person at that restaurant and they say, I can't get yield. How high is being a yield pig? Is it 6%, 7%? Where do you get stupid?
Well, I think you get stupid now by going down the capital structure and some of the triple Cs. Where we think there's value is really in the higher quality elements of high yield and in the bank loan market. Right now, that's really a 5, 6, 7% type yield. The indices in high yield are closer to 8 or higher. We would avoid some of the lower quality, stay senior right now. Bring
up chart 10 if you would here, please. National savings. This is a blended national savings, and you can see the government savings, ugly. Our savings, pretty good, and of course, corporate savings to the rescue. This is a critical question. For 2012, are we going to see the cash on those balance sheets retire equity and issue out bonds? Are we going to see a lot of bonds in 2012?
Well, we'll probably see certain sectors delever, such as the banks. So it's advantageous to be up the capital structure in those. Although in some companies, for example, pharmaceutical tech companies, you're going to see more corporate bond issuance to fund share buybacks. We saw that last week with Amgen. Is that a good thing mathematically?
Yeah, the Amgen, is that a good thing?
It's not a good thing for a bond.
I'm thinking M&M theory, chapter 14, it was 3 in the morning.
Well,
does that make sense?
It makes sense for the equity holders. It does not make sense for the bondholder. This is critical, and this is what PIMCO does. We really decide where is it best to be in the capital structure. Where is the company managing for the benefit of the underlying investor? For the banks, the companies are delevering, which is good for the bondholders. For a lot of these other companies, they're now using that cash on balance sheets, issuing debt, and doing share buybacks. That's what we're trying to avoid as a bond investor.
I mean, this is a critical, it's like a free lunch for equity investors. We got to go. I got to come back again so you and I can start the show and forget about those other two guys. Mark Kiesel, thank you so much.